Well, the Chinese economy had its slowest growth in about 25 years, but any other country, it would be, they'd be popping open the champagne. For all of 2015, 6.9% growth. Weak currency and concerns about consumer spending in China, a big part of the reason. And news for China, though, helping push the U.S. stock futures higher this morning. The Dow Industrials lost nearly 400 points on Friday at last check, pointing to opening up about 236 points at 8:30 our time this morning. A slight jump in crude oil prices helped. So you didn't win the Powerball. And to make matters worse, 10 trading days into the new year, it's been a terrible ride. Financial consultant Derrick Kinney doing a lot of hand-holding these days, playing amateur psychologist.
That's right, making sure people don't jump out of a window or anything like that.
Basically, the American economy is in pretty good shape. It's the rest of the world we're worried about.
It is, Tim. When you think about the U.S. in isolation, things look pretty good here. Housing looks good, corporate earnings numbers look good, jobs numbers look good. The problem is when you see it bleed over into the entire economy around the world, that's where we get into trouble. And the perception right now is because we're seeing global concerns about slowing, concerns about could the U.S. be slowing as well, are causing people to be very, very concerned. We have a high amount of volatility right now, but investors have to stay focused on their goals and not be distracted on what everybody else is saying maybe could happen.
So if the U.S. currency, another thing that's very strong, which is not entirely good news, because if I'm Ford making a car trying to sell it in Europe, it's more expensive over in Europe.
Right.
And that's not good.
That's right. And the key here becomes what we let go out of the country and what we bring in. And in terms of the economy, right now we've got so much oil here, which I think a couple years ago we wanted to have energy independence. Now we have that, and it's created its own set of problems. When you go to the pump and pay for gas, it's great to have that savings. When you buy a certain stock, though, it may be down quite a bit. The bottom line is diversification is the key, but really knowing what investments do what these days is really what counts.
Do you have clients who are saying to you, pull the plug now, get me out of this before it craters? Because there is suddenly, the financial magazines are polling economists and saying, do you think we'll go into a recession?
Right. Most of the reputable economists, Tim, as I would call them, kind of the middle of the room people, are saying there's probably not a high likelihood of recession or depression, but it may feel like it. And oftentimes how people act leads the economy to follow suit. We've seen people working. We have a very, very low unemployment rate. Company earnings numbers are going to be the key this week. We've seen a couple companies last night say earnings are better than expected. That's going to be the one pathway to possibly getting out of this concern about oil, concern about the overall global economy.
And again, it is all tied together because we buy things from China and from Europe. They buy things from us. We're no longer an island unto ourselves. But if we looked at the United States as an island, there would be a lot of reason for optimism.
There would be. Think about our viewers right now that may have a 401k, perhaps their biggest retirement asset. The day-to-day gyrations of the market don't always have a big impact on them, but it's the long term. Let's say, Tim, somebody's watching right now thinking, I'm really panicked and worried. One option may be move the bulk of the 401k to be more conservative, but keep adding money every month out of your paycheck into the growth areas while it's low. So you're taking advantage of opportunities, but protecting the bigger nest egg.
If you have the choice, though, between that or doing something else with your money, there are some people who say, I'm going to invest in the stock market, or I'm going to pour my money into my retirement plan. But they've got credit card bills hanging over their shoulders. Would it be wiser for them to pay off those credit cards now while the stock market is kind of in limbo?
Yeah, ideally you'd want to wait till the market goes higher, take some of those gains, and then take the profits and pay off this lower interest rate debt or higher interest rate debt. But you want to make sure you're saving for both goals simultaneously. Have 3 to 6 months of committed living expenses built up for those emergencies that tend to come up. But sock away money for retirement long-term or education for the kids. Now you've got both goals being funded together. But don't panic. On a day like Friday, don't pull everything out. On a day like today, don't buy the high dollar wine. Keep it in moderation is the key.
You're talking my language.
That's right.
We have a link to your website on fox4news.com. Derrick, thanks very much.
My pleasure. Thank you.